Picture a steel vault somewhere under London or New York. The air is cold and dry, the lighting harsh, and endless shelves of gleaming gold or silver bars sit stacked in perfect rows. On paper, those bars belong to people and institutions all over the world: pension funds, hedge funds, ETFs, industrial users, central banks. Now imagine that in a single line of text on a bank's internal system, 3,000 ounces suddenly move from Deutsche Bank to J.P. Morgan. Nothing has physically shifted yet, but in legal and financial terms, an enormous transfer of power just took place. The headline screams, "Bank War. Deutsche Bank just lost 3 million ounces to J.P. Morgan." It sounds like a heist. It feels like one bank just outplayed another in some high-stakes game of Bullion chess. But what does it actually mean to lose 3 million ounces? Is it theft, a default, a clever trade? Or is it something far more mundane, but in some ways more unsettling? A glimpse into how fragile and opaque the modern metals and banking systems really are? First, scale this in your mind. 3 million ounces of gold would be astronomical, more than 90 metric tons, worth well into the billions of dollars at typical prices. 3 million ounces of silver is far smaller in dollar terms, but still a serious stash. A single standard silver bar is 1,000 ounces, so 3 million ounces is roughly 3,000 big bars. Imagine a warehouse with pallets of bricks. Now imagine those bricks each worth tens of thousands of dollars. That is what banks play with when they trade in ounces. In everyday language, you own what you can touch. If you buy a gold coin and hold it in your hand, that's simple. But in the institutional world, ownership is abstract. Most of the gold and silver traded between big banks does not sit in trucks moving around every day. It exists as entries in a ledger, claims on metal that may or may not be specifically set aside for you. When you see a sensational line about one bank losing metal to another, buried underneath is the story of how those claims are created, pledged, borrowed, and sometimes trapped. Deutsche Bank and J.P. Morgan are not jewelry stores. They are what's called bullion banks. They make markets in gold and silver, hold metal for clients, lend it out, use it as collateral, and manage complex derivative books tied to the metal's price. On certain exchanges, like COMEX in New York or in the London over-the-counter market, these banks dominate the system. Between them and a handful of others, they clear most trades and hold most of the metal that backs futures contracts and institutional products. So how can one of them lose 3 million ounces to another? There are several ways, and almost none of them look like a movie-style robbery. One possibility is that the metal was pledged as collateral for a loan or a derivatives exposure, and a move in the market triggered a transfer. Another is that Deutsche Bank was acting as custodian for a product or a client that decided to move their holdings to J.P. Morgan's vault network instead. Or the loss could simply be the closing of a position. Deutsche Bank owed J.P. Morgan metal, and at settlement, the metal was delivered. The key is that in this world, an ounce is not just a lump of metal. It's a unit of risk, collateral, and trust. When a bank has 3 million ounces, that might not mean 3 million ounces sitting in a vault labeled with its own name. Much of it may be unallocated, a pool of metal where the bank owes its clients ounces, but the metal is part of a common pot. Some may be leased out. Some is used to hedge client positions. And some may even be pledged more than once, a practice called rehypothecation, where the same underlying asset underpins multiple obligations. This is where the story gets both technical and suspenseful. Because once you understand how these claims are layered on top of each other, you realize that small shifts in ownership on a screen can hint at much bigger pressures underneath. Did Deutsche Bank lose those 3 million ounces because it was forced to meet margin calls in a volatile market, while J.P. Morgan was on the winning side of the trades? Did a large client lose confidence and switch custodians? Or is this part of a quieter, ongoing restructuring of who holds real, physical metal and who is left with paper promises? You can think of it like musical chairs, except the chairs are gold and silver bars, and the players are global megabanks. As long as the music plays and almost no one asks for delivery of actual metal, the game looks harmless. But when the music slows, when markets wobble, the question of who has real, deliverable metal and who only has paper claims suddenly becomes critical. A newsy line about one bank losing ounces to another might be a trivial ledger shuffle, or the first visible crack in a stressed system. To untangle it, you have to go inside the plumbing of the bullion market, how contracts are written, how vaults are audited, how banks use metal the way they use government bonds, as prime collateral in a world always hungry for safety. And you have to understand why, in that world, J.P. Morgan's gain is often not just Deutsche Bank's loss, but a shift in the balance of power. Because in any market where confidence rests on a small number of players being rock solid, the one who quietly accumulates the best collateral, the real stuff, holds an advantage that may only become obvious when something breaks. The unsettling question the headline raises is not just what happened between these two banks. It is, what might this tell us about everyone whose wealth directly or indirectly depends on them? In the next step of the story, the simple phrase 3 million ounces will turn out to be layered with leverage, obligations, and hidden fragilities. And that is where the bank war really begins to look less like a headline and more like a structural fault line running beneath the global financial system. To understand what it really means when metal shifts from Deutsche Bank to J.P. Morgan, you have to leave the world of headlines and step into the engine room of modern finance. It is a world built on the idea that you do not need to move the metal itself very often. You just need a trusted web of promises around it. When those promises are rock solid, the system hums. When they're not, a 3 million ounce transfer can signal far more than it appears. Start with the basic distinction that almost no sensational headline explains: allocated versus unallocated metal. Allocated metal is like a safety deposit box. There's a specific bar with a serial number, weight, and purity explicitly held in your name. If the bank fails, that bar is your property, not part of the bank's assets. Unallocated metal is different. It's a general claim against the bank, like a bank deposit. The bank owes you ounces, but the metal sits in a big pool. It can be lent out, swapped, pledged as collateral. Most big bank gold and silver business is unallocated because it's flexible and easier to trade in bulk. Now add the futures markets, like COMEX. There, traders buy and sell contracts that promise delivery of metal at a future date. Most never see the metal. They trade price risk and close positions in cash, but the contracts are backed, at least in theory, by metal in registered and eligible categories and approved vaults. Who are the vault operators and clearing members? Again, the same handful of global banks. J.P. Morgan is one of the largest players. Deutsche Bank has historically been smaller in bullion, but deeply involved in derivatives and structured products. In this structure, metal becomes a kind of multi-tool. A bank holds it in a vault. It promises ounces to clients via unallocated accounts. It also may lease some of that metal to another institution, earning a small yield. It may use the same metal as collateral in the repo market, borrowing cash against it. It may enter into swaps, where it lends metal and receives dollars, then promises to return dollars later and get its metal back. On top of that, it might write options or structured products to clients that pay off based on the price of the metal. All of these moving parts are linked by the assumption that the bank can always meet its obligations, either by sourcing metal from the market or rolling positions over. Now imagine a stress event. Metal prices move sharply. Clients demand more hedging. Short positions get squeezed. Margin calls hit. In derivatives, when you are on the losing side of a price move, you must post variation margin, extra collateral, to your counterparties. That collateral can be cash, government bonds, or in specialized segments, physical metal. In a squeeze, a bank that was short futures or heavily hedged in a way that backfires could face a sudden need to deliver real ounces. This is where a loss of 3 million ounces can sneak into the headlines. If Deutsche Bank had exposures that went against it, and J.P. Morgan was on the right side of that trade, margin calls could be settled by transferring title to metal. On a screen, that looks like a simple line: 3,000 ounces, Deutsche to J.P. Morgan. In economic terms, it's the crystallization of losses that were previously just potential. In systemic terms, it's one institution's liquidity problem becoming another's collateral upgrade. But not all transfers are forced. Sometimes they are about control and confidence. If large clients, say a major ETF, a sovereign wealth fund, or a big hedge fund, decide they no longer want Deutsche Bank as their bullion custodian, they can instruct that their allocated bars be moved to another vault provider, frequently a competitor like J.P. Morgan. The decision might be driven by something as simple as fees or as serious as concerns about the bank's stability or reputation. Again, the ledger shows a shift of millions of ounces. Underneath, it's a vote of no confidence, or at least a rebalancing of trust. There is also a quieter, more structural battle always going on, a battle for the best collateral. In the global financial system, not all assets are equal. Government bonds of strong countries and fully allocated bullion in top-tier vaults are considered high-quality collateral. They grease the wheels of lending, derivatives trading, and interbank funding. If J.P. Morgan manages to accumulate more of this prime collateral, either by client inflows by winning in trading, or by buying when others are forced sellers, it strengthens its position as a central node in the system. If Deutsche Bank, conversely, ends up with more illiquid, lower quality assets and fewer top-tier metal holdings, its position weakens. This is not a conspiracy theory, it's standard market dynamics. But it creates an environment where a line like Deutsche Bank lost 3 million ounces to J.P. Morgan may mark a structural trend, one bank consolidating power, the other retreating. J.P. Morgan's role as a clearing bank, custodian, and derivatives powerhouse has grown over years. Deutsche Bank, by contrast, has been restructuring, shrinking risky books, and exiting or scaling down some businesses after years of scandals and regulatory pressure. The suspense comes from what you cannot see. From the outside, You can track some vault data, some COMEX reports, some ETF holdings, and occasional news about custody changes. But you cannot see the full network of swaps, rehypothecation chains, or which promises of metal are backed by specific bars versus vague, unallocated pools. When a big transfer occurs, you are seeing only the shadow of what might be a much larger struggle for liquidity and safety. The crucial question becomes, was this transfer a routine realignment in a normally functioning market, or a symptom of stress where one bank tightens its grip on real metal while another quietly bleeds it away to plug holes? To answer that, you have to zoom in further on how these specific banks have behaved in the bullion arena, and why J.P. Morgan, in particular, keeps showing up at the center whenever gold and silver markets come under pressure. Deutsche Bank and J.P. Morgan are not just names on vault doors. They are characters with long histories in the drama of global finance. To understand the deeper meaning behind a reported loss of 3 million ounces by Deutsche Bank to J.P. Morgan, you have to recall their roles in past crises and controversies. Over the last 2 decades, Deutsche Bank's reputation has been battered by involvement in benchmark manipulation, LIBOR and FX, money laundering probes, and large derivative exposures. It has repeatedly had to reassure investors and regulators that its balance sheet is sound even as it cut back risky businesses and shrank its investment bank. In some areas, it simply withdrew rather than continue to fight for market share against stronger, better capitalized U.S. rivals. J.P. Morgan, by contrast, emerged from the 2008 crisis as one of the clear winners. Backed by a strong deposit base and U.S. government support during the heat of the turmoil, it bought distressed competitors, absorbed pieces of Bear Stearns and Washington Mutual, and consolidated its role as a top global dealer. In precious metals, it built up custody businesses, took on clearing roles, and at various points held a substantial portion of the metal stocks tracked by exchanges like COMEX. In the gold and silver world, J.P. Morgan's name recurs in another, more controversial context: price manipulation allegations. The bank and some of its traders have faced regulatory actions and fines over practices like spoofing, placing and canceling large orders to nudge prices. Without indulging in conspiracy, it is safe to say that J.P. Morgan's metals desk has historically been both powerful and aggressive. That matters, because a big metals book gives you not just profit opportunities, but information and influence in a market where liquidity can be thin. Deutsche Bank has had its own brushes with metals scandals. It has been named in lawsuits and regulatory probes regarding precious metals price fixing, and in some cases has cooperated with investigators against other banks. Over time, though, it has clearly been retreating from some commodities and complex derivative niches. When you see word of a significant bullion transfer out of Deutsche Bank orbit into J.P. Morgan's, it fits a longer story, one institution pulling back, another tightening its grip. Now, consider the mechanics of such a transfer more directly. Imagine Deutsche Bank had long-standing swap lines and hedging arrangements, possibly involving central banks, large funds, or industrial users. These clients rely on the bank to provide liquidity, to take the other side of their price risk. If the bank decides to shrink that business, those clients must find a new partner. J.P. Morgan is an obvious candidate that can involve bringing metal with them. Allocated bars once sitting under Deutsche Bank's custody could be picked up, both literally and figuratively, and moved into the J.P. Morgan Vault network. Alternatively, picture a derivatives book where Deutsche Bank previously ran a sizable position. Over time, as it cuts exposure, it may unwind trades with J.P. Morgan settling in physical metal where that makes sense. J.P. Morgan, with a stronger balance sheet and more appetite for the business, can absorb that metal, using it as raw material for its own hedging and client activities. The line, lost 3 million ounces, might, in that context, be better phrased as exited 3 million ounces of exposure that J.P. Morgan was willing to take on. But the word lost lingers for a reason. In any transfer, someone is on the back foot. If the move is forced, triggered by a margin call or a liquidity crunch, then the party losing the metal did not choose the timing. They may have to sell or deliver into a weak market, crystallizing losses. The receiving bank can then hold, repledge, or sell into strength later. That asymmetry is where power consolidates. It also raises a thornier question. Who ultimately bears the risk when metal is shuffled between banks? If Deutsche Bank's clients believed they held unencumbered bullion, but in reality, their assets were mixed into unallocated pools which had been relent or pledged, then stress could expose uncomfortable truths. Transferring custody to J.P. Morgan might resolve one problem, counterparty risk to Deutsche, while leaving untouched the deeper issue of how many claims exist on the same underlying bars. Here, the suspense cuts closer to ordinary investors. Many people hold gold and silver exposure through ETFs, structured notes, or unallocated accounts marketed as good as physical. In practice, those claims are only as solid as the chain of custody, the legal segregation of assets, and the solvency of the intermediaries. When you see two giant banks in a tug of war over millions of ounces, it should prompt a question. If there were ever a genuine scramble for physical, would every claim be honored in full, or would some holders discover that their ounces were more like IOUs? The answer depends on detailed legal fine print and on how stressed the system becomes. In calm times, the machine works. Bars sit quietly in vaults. Electronic claims trade by the millisecond. Few people ask to take delivery. As soon as a real or perceived shortage emerges, say a surge in investor demand, a breakdown in mining supply, or sanctions that tie up central bank gold, the game changes. Those who control physical, allocated metal at the top-tier vaults have options. Those lower in the hierarchy, with only unsecured claims, face a much rougher landscape. A shift of 3 million ounces from Deutsche Bank to J.P. Morgan is, therefore, not just about the two logos in the headline. It is a clue to an underlying hierarchy forming and reforming, which institutions are climbing toward the top of the collateral pyramid and which are drifting down. The suspense lies in not knowing how the hierarchy will matter when the next shock hits, and who, if anyone, will be left relying on promises that suddenly feel much less as good as gold than they were sold to be. To see why this bank war over metal matters beyond institutional pride, you have to follow the chain from vaults to prices and from prices to market stability. When millions of ounces move from one major player to another, it can alter the dynamics of futures markets, change the odds of a squeeze, and affect how easily big institutions can hedge. All of that feeds back into the price signals everyone else relies on. Consider how a futures market like COMEX functions. Commercial users, miners, refiners, and banks use it to hedge price risk. Speculators use it to bet on direction. The contracts are standardized promises. At expiration, the seller will deliver a given amount of metal, and the buyer will accept it, unless they both roll or close the contract beforehand. In practice, only a small fraction of open interest ever goes to delivery, but the possibility must always exist. For that, you need deliverable stocks and approved vaults. Now imagine that J.P. Morgan, by accumulating an additional 3 million ounces, tightens its grip on the pool of deliverable metal. It controls a larger fraction of the bars that can meet COMEX obligations. That does not necessarily mean it can dictate prices at will. There are still global flows, other vaults, and arbitrage, but it does increase its ability to absorb or withhold supply tactically within the rules. In a market where a short squeeze threatens, where many shorts face the prospect of having to deliver metal they do not readily have, a single player with ample stocks can choose to ease the pressure or let it intensify. From Deutsche Bank's perspective, losing that metal weakens its ability to offer delivery, to make markets comfortably, or to reassure clients that its hedges are fully backed. It may have to rely more on buying in the market, on borrowing metal from others, or on using cash-settled derivatives instead of physical positions. Each of those options makes it more vulnerable in a stressed environment where liquidity dries up and counterparty risk spikes. This imbalance can create a form of soft power. Clients who sense that J.P. Morgan has deeper access to physical and better control over its metals book may prefer to route trades in custody there. That further concentrates metal and flow in J.P. Morgan's hands. Meanwhile, Deutsche Bank's reduced footprint might force it to pay more when sourcing metal, accept tighter limits on its trading activities, or even exit some client relationships. Over time, the gap widens. The suspenseful part is that this concentration can cut both ways. In calm markets, having a dominant, well-capitalized player handling a large share of bullion activity can be stabilizing. Liquidity is deep, spreads are tight, hedging is easy. But if something unexpectedly undermines that player, a legal shock, a massive loss in some unrelated part of its business, a regulatory clampdown, the entire market can seize up. When everyone depends on the same hub, the hub becomes a critical point of failure. Think of other commodity markets that have snapped under pressure. The nickel market on the London Metal Exchange in 2022 experienced a brutal short squeeze that forced the exchange to cancel trades and suspend the market. A single large short position combined with constrained physical supply created a feedback loop. If a major bullion bank with huge physical and paper positions were to find itself on the wrong side of an extreme move, something similar could unfold in gold or silver, magnified by the fact that these metals are also held as macro hedges by investors worldwide. A 3 million ounce transfer is not by itself that kind of crisis, but it is the sort of adjustment that either builds resilience or fragility, depending on how diversified the system remains. If J.P. Morgan is genuinely hedged, acting conservatively and matched by strong competitors, its growing metal hoard might simply reflect efficient specialization. If, instead, it is emboldened by its size to take on larger and more one-sided risks, banking on the idea that it is too important to fail, then each incremental ounce under its control quietly raises the stakes. Meanwhile, the pricing that trickles down to retail investors, the quotes you see on your screen, the spreads on your ETF, the cost to hedge, are all influenced by this invisible tug of war. When collateral is tight, banks may pull back from market making, widening spreads. When regulatory changes force them to hold more capital against trading books, they may reduce open interest on futures, lowering liquidity. In such times, a bank sitting on a massive metal cache has an advantage. It can step in when others step back, potentially at favorable terms. For ordinary savers, this raises a subtle but important risk. You may believe you are diversified because you own some gold or silver exposure alongside stocks and bonds. But if that exposure is through products that rely on a small number of banks for custody, hedging, and liquidity, then in a systemic stress, you are more exposed to those banks' fortunes than you realize. A bank war over who controls physical ounces is indirectly a war over whose promises your wealth ultimately rests on. The next twist, then, is not about whether Deutsche Bank or J.P. Morgan won a particular skirmish. It is about what this kind of transfer reveals regarding the structure we all sit on. Layers of paper claims, a shrinking circle of dominant dealers, and a market whose apparent smoothness depends on a few key players never stumbling at the same time. That is where the story of 3 million ounces turns from an institutional rivalry into a question about systemic vulnerability, and about what, if anything, investors can do to insulate themselves from it. When you strip away the drama of headlines like Bank War, Deutsche Bank Just Lost 3 million ounces to J.P. Morgan, what remains is a set of hard questions about trust, transparency, and risk in modern finance. The real suspense is not whether one bank outsmarted another on a particular trade, but whether the entire architecture of paper claims on real assets can withstand the next major shock. For individual investors, the first and most important realization is that many familiar products are, at their core, chains of promises. A gold ETF is a promise that someone, somewhere, holds metal matching the shares outstanding, and that the legal and operational setup will actually deliver that metal, or at least full cash value, under stress. Unallocated accounts at a bank are promises that you can convert your claim into physical on demand, even if the bank has lent or pledged some of the underlying metal. Futures contracts are promises that, if you insist on delivery and follow the rules, there will be a bar waiting. Transfers of millions of ounces between major bullion banks show that these promises are constantly being reshuffled. Sometimes that is benign. A client changes custodian, a bank exits a line of business. A winning trader collects his due. Sometimes it is a sign of tension. An institution meets margin calls by delivering metal, a competitor quietly strengthens its hand while another weakens, or regulators push a bank to de-risk. From the outside, it can be hard to tell which is which. The pragmatic response is not panic, but clarity. If you are using gold or silver as a hedge against financial system risk, you need to understand how tightly that hedge is tied to the very institutions you are worried about. Holding some metal in fully allocated form with clear legal title reduces your dependence on any one bank's balance sheet. Diversifying across custodians and jurisdictions spreads risk further. Using unallocated accounts and derivatives may still make sense for trading and liquidity, but you should treat them as exposures to bank credit and market structure, not as perfect substitutes for coins in your hand. At the same time, it is important to resist the temptation to see every shift of ounces as proof of imminent collapse. The bullion market has survived wars, currency crises, and financial panics by evolving. Clearing systems improved, reporting increased, some forms of leverage were curbed. Regulators today are more aware of the dangers of excessive rehypothecation and concentrated dealer power than they were in 2007. Large banks carry more capital and face tighter scrutiny over their derivatives and commodities books. Yet the fundamental tension remains. We live in a world where claims on assets can multiply far beyond the underlying physical, and where a small group of global institutions sit at the center of most markets. In such a world, bank wars over collateral are not sideshows. They are part of how power and vulnerability rearrange themselves beneath the surface. Each headline-worthy transfer hints at that deeper process. So what does it mean, ultimately, if Deutsche Bank loses 3 million ounces to J.P. Morgan? It means that in this round, J.P. Morgan has tightened its grip on a pool of scarce, high-quality collateral that lubricates the entire metals complex. It means Deutsche Bank has, for one reason or another, stepped back from that same pool, whether by choice, under pressure, or by the logic of markets rewarding the stronger balance sheet. It does not by itself foretell disaster, but it does nudge the system a little further toward concentration. The unresolved question is what happens when the next big stress comes, whether from inflation, geopolitical shocks, a sovereign debt scare, or an unforeseen failure elsewhere in the derivatives web. In that moment, those who hold real allocated metal at the core of the system will have options. They can meet obligations, roll positions, or negotiate from strength. Those further down the chain, with only synthetic exposure and weaker claims, may find that what looked like solid ounces on a statement are actually just one more link in a fragile chain of IOUs. In that sense, the The real hook in a story about banks battling over bullion is not the rivalry itself, but the invitation to look more closely at the foundations of your own financial life. How much rests on trust in intermediaries? How much is explicitly legally yours even if an intermediary fails? How exposed are you to the decisions of a handful of global institutions, trading billions in assets you never see? The suspense will not be resolved in a single headline or a single transfer of 3 million ounces. It will play out quietly in how regulators shape market rules, how banks manage their balance sheets, how investors choose between convenience and control. But each time you see a story about one bank losing metal to another, you can read it as a reminder. In the background of everyday prices and products, a contest is always underway over who holds the real collateral, and over who, when the music slows, will discover that their chair was only ever a promise,